key piece of advice here is getting your advisory team in place as early as you can. Lawyers, accountants, corporate finance advisors. And you really need to make sure that they're in touch and integrated with your own internal deal team. I think aligned to that is also making sure that those advisors are the right ones for the deal. So yes, importantly, that they have real experience in the financial services sector, but also in the part of the market in which you are operating. And that means understanding the regulatory environment, so the FCA, the PRA and their rules, as well as the commercial realities of your particular business. I think in addition, where you have a regulated company, there are specific hurdles that you need to clear to get a deal done, and having the right people around from the outset really makes a significant difference. At a high level, you're typically looking at whether you're doing a share sale or a business sale. In a share sale, the buyer acquires the shares in the company, so all of the assets and liabilities stay with it. In a business sale, you are only transferring typically specific assets and take responsibility for specific liabilities that are identified in the legal documents. For FCA-regulated businesses, there's an additional step, which is that you may need a change of control approval from the FCA. And that can have a real impact on the timetable if it's not addressed early and dealt with properly. It's also worth in mind thinking about what are your strategic aims or objective. The key message here is to work closely with your advisors to find the structure that best meets those objectives, and also then protects the ongoing business and client relationships. I think it's really crucial to start your tax planning as early as possible. That really is the single most important point here. Leaving it too late can cause real delays, or even worse, can mean that you miss out on more favourable tax treatment that would have otherwise been available with better earlier planning. For owner-managed businesses, which are quite common in financial services, particularly insurance and other mid-market businesses, there are potential layers of complexity. So for example, a seller's shareholdings could be held personally or in a trust or in fact in a holding company. And that brings some complexity. In addition, the question of what your role in the company is, are you an employee or a director? And what is your personal tax position? Those are all things that come into play. On the corporate side, with transactions involving owner-managers, there are often also employment tax considerations, particularly with transaction bonuses. There are also some sector-specific issues for financial services businesses, so you sometimes need to think about the tax treatment of things like deferred compensation, and really any compensation that's linked to employment, and also in private equity deals you've got tax on carried interest as well. I think the business needs to be sort of in a state of general readiness, thinking about sort of getting your house in order before a buyer comes through the door. There's some easy things that business owners can do. So for example, making sure that financial records are accurate and up to date. That's going to be really important and is what a buyer will base their valuation on. And for regulated firms, that includes things like capital adequacy calculations and client asset reconciliations. On the corporate filing side, things like company's house filings, keeping statutory registers up to date, making sure you have things like share certificates, etc. If there are issues with any of that, it's far better to fix them in advance rather than have them surface during due diligence, which can just add cost and delay. Things like commercial contracts and the key contracts should be accessible and reviewed in advance. So looking out for things like change of control provisions or contracts that are nearing their expiry or which have otherwise onerous terms. In regulated businesses, that can be things like agreement with, yes, your clients, but also investment management arrangements. Those often have key clauses that need particular attention. We also then have arrangements with employees. So, of course, these need to be in order. Companies should have formal employment agreements for staff, but also things like records. So, for example, visa records. For regulated firms, there is also then the senior management documentation, and having records of things like training and certification will be important. I think finally, sort of things like making sure the company owns and can demonstrate ownership of its assets, especially those key ones that are crucial to running the business. Again, very important to have checked beforehand. This is really one of the key challenges in sell side on an M&A transaction. A sale process is time consuming and it can pull management attention away from the business. And of course, if business performance dips during the process itself, that could have sort of negative consequences and even impact, the buyer's confidence in doing the deal. I think it's really important, especially for financial services business, to focus on things like compliance and making sure that that is all both up to date as at the time of the transaction starting, but also continues throughout the transaction process. You can also plan for distraction. So you can think about things like delegation or bringing in extra resource if needed. And also having sort of robust frameworks in place for things like compliance and risk management will also be helpful.